We're in the middle of a bear market. A bear market is one where the market declines 20% or more over at least 2 months. Bear markets indicate a downward trend and tend to be triggered by a correction where the market drops between 10% and 20% in a short time. We've had 26 bear markets since 1928, and 9 resulted in a recession. The first, the Great Depression. The bear market started on September 7th, 1929, and continued until March 1933. Between these dates, the stock market lost 73% of its value and unemployment peaked at 24.7%. The country did not fully recover until around 1939. The second one was June 1948 to June 1949. It lasted a year. An 11-month recession began in November 1948 and lasted until October 1949. This was caused by the rapid increase in interest rates. A recession happened again in 1958 when the market dropped 21.63% and stayed down for 446 days. August 1956 to October 1957. The fourth is November 1968 to May 1970. Yes, almost 2 years. The market lost almost 40%. The recession started in December 1969 and ended in November 1970. Number 5 is a recession for close to 2 years. It was January 1973 to October 1974. The market lost 48.2% market dip. The recession had lasted 16 months, with much of the economic woes starting with the OPEC oil embargo. Unemployment rates peaked at 9%. Number 6 is a pretty historic one. November 1980 until August 1982. 622 days. The market dropped 27.11%, and it was so bad a recession happened twice within that time. The first was in the first 2 quarters of 1980, and the second one from July 1981 to November 1982. Unemployment went up 10.8%. Seventh is the most memorable and painful. This was caused by the dot-com bubble bursting. It started in March 2000 until September 2001. That is 546 days. The market lost 36%. During this time, an 8-month recession hit the country. The recession culminated when the 9/11 attacks happened. 8 is from October 2007 until November 2008, with a 52% drop in the market. This is when the housing market collapsed, causing 10% in unemployment. It is now known as the Great Recession. The most recent one is from February 2020 to March 2020. Yes, it's pretty short, but the drop was 34%. COVID caused it. It contracted the economy by 31.4% and raised unemployment to 14.7%. So what's the bottom line? Bear markets are a natural part of the investment cycle, and the best way to avoid them is to not be scared, but to be prepared. Remember to regularly examine your portfolio and study different assets. More importantly, diversify. If you are heavy in stocks, make sure to look for assets that move against stocks, such as gold. I hope you enjoyed the video. Don't forget to hit that like button and subscribe if you have not already. This is Risk Flex with Noble Gold News.